if we have 200,000 at, we'll call it 2%, and then 100,000 at 15% for the consumer debt, calculate that. That has a blended rate of 6.33%. Obviously, if you're able to lower the interest rate, great. But we're talking about changing the blended rate. So if you consolidate any consumer debt that you have that typically has a higher rate of interest, and even if you have one of those super sexy low interest rates around 2%, if your blended rate is higher than, well, what we were looking at here, 5.875, then you can lower the total interest that you're spending. In the example that I gave, the blended rate, if you have $200,000 at 2% mortgage, and then you have 100,000 at 15% of consumer debt, then you're at 6.33% total debt rate. So if you consolidated that and you brought your blended rate from 6.3 down to 5.8, you're saving some interest there. But the conversation I was having with this real estate agent friend of mine was, what if some of the consumer debt that you paid off was an auto loan, right? So if you have a car loan out there, the other cost that's associated with an auto loan is your insurance. But if you had a high interest and you're paying off an auto loan, then you can also amend your car insurance from full coverage to liability only. So it's saying on average to switch from full coverage to liability saves $1,300 to $1,600 per year, which is $110 to $130 per month on the monthly budget. And every day I like to get on there, price out a few of the deals to give people access to not just tell you that my rates are lower or better or whatever. And so what I'm really doing is I'm holding the feet to the fire of my competition to make sure that they're going to be giving you a good deal. So if I'm not the one that's going to provide you the good deal, at least you're able to take what I'm doing and bring it to them and make sure that they give you a good deal.